I think we have just one big topic today. We're gonna get grumpy. I'm gonna be the grumpy old man value guy and argue against growth stocks not very well or systematically, and you're going to defend them. I think that's my interpretation of how this is going.
Hit me hard.
All right.
Growth stocks versus value stocks.
Yeah.
Actually, I'm growth, you're value.
Right. This is not a fair fight. I should start out with that. This is David versus Goliath. Value has, I have no seat at the table.
I would say it's more like this, the rabbit versus the turtle.
Rabbit versus turtle. Okay, I'm a turtle.
You're a turtle.
Okay, tortoise and hare.
Tortoise and hare. Yeah. I think that's the right animals.
Right. Okay. Yeah. All right. I like that. That works. Okay. So I was looking for a piece of research that I didn't end up finding, but the piece that I wanted to convey to you is basically the issue with growth stocks with high expectations. That in expectations investing, which is how all investing works, right? Expectations on future things.
Correct.
Growth stocks, especially the most richly priced growth stocks, have such preposterously high expectations baked into them. For instance, 20, 30, 40% growth on revenue for a decade, that the likelihood of achieving this is incredibly small. And the recent past, of course, would congratulate anyone who has bought the growth story and been long growth, especially post-COVID, and especially junky growth, like poor quality growth has done really, really well, much more so than anything value has. I'm just stamping my opinion on the universe here. That here in the middle of the year of our Lord 2021, I don't think they can keep going forever. I don't think you can keep investing in the highest expectation companies and get good returns on capital. I think that will cyclically end, and you will see a return to value, cash flow, strong balance sheets, and that the growth story will not end well for everyone who's over allocated to it.
Okay, I will tell you one thing. This is my biggest fear ever. It's when somebody will wake up and say, "Why am I paying 30 times revenue multiples for this company?"
That's your nightmare.
And then one day, like they're like, "Oh, just sell this," and everybody does the same thing, and then suddenly you have growth stocks trading at normal valuations. Normal meaning pre-COVID, I would say pre, but the other point of view here is saying, but what happened if you were wrong before? Maybe in 2015 the growth stocks were undervalued.
I think hindsight would tell you that is most certainly the case.
And
right?
they're now fairly valued, which I wouldn't argue that, but they might have stretched a little bit, but they're still. Let's
step back real quick and let's talk about the universe we're talking about, because I caveated my statement very, very strongly by saying the most overpriced growth stocks, right? Was it you and me who looked recently for price to sales ratios that were the worst that we could find, right?
Yeah. Because I think so first of all, this is not investment advice as usual, but I had sold a company called Cloudflare because I held it for just over a year, and the outperformance was incredible. I think I performed, the stock went up 175%. Something like that. And the multiple was at an all-time high. I think the price sales ratio from the trailing 12-month one was 65, which, at the peak of Amazon in the 2000, in the bubble, probably at 40.
Yeah. So price to sales.
Price to sales. And then Amazon just fell 85% from then. So the problem is that this company, Cloudflare, I view it as the backbone of the future internet. It's going to be the backbone of the future internet. It will be as big. It will be second only to maybe Amazon AWS in terms of size. Just because AWS is I would say the plumbing, the foundation of everything, and then I don't know how to explain this, but it's
Cloudflare is integral. is what you're saying.
Totally integral. It is the roads of the internet, essentially. They manage the roads of the internet. And Amazon, in my metaphor, is that Amazon is the foundation of every single real estate building on the internet. Mm-hmm. That's not true, but, because you could use Google Cloud or,
Azure.
Azure. Which is
word.
Microsoft's version. In fact, the capital commitments required to launch a new cloud computing platform are so large that only the big tech companies can do it. And there's 3 in the US, there's 2 in China, 1 in China, and then there's, I don't know, there might be another one here and there. But other than that, this is everything else. Everybody else plays in niches. But yeah, so as long as the growth story remains intact and for a long term.
What is the growth story?
The growth story
what do you
there
mean
is
the growth story. We're talking about all about the same one, or are you talking about the Cloudflare?
No, Cloudflare in particular, because it was super duper expensive.
Okay.
As long as they can grow on a consistent basis 50% for the next 10 years, they're fairly valued. The problem is the moment you have a scare, the moment you have growth slowing down for some external reason, or new competition shows up, or something shows up, that premium that you're paying for goes to average, maybe, let's say, it goes from 65 to 15. And so it's going to be very, very hard from then to recover any investment. And I just want to point out, I have a little bit of graph here where it kind of shows you, I don't know if you can see this.
Top performers.
Revenue growth is the chief source of long-term shareholder value.
Okay. TSR.
But it always says the same thing. What is TSR is total shareholder return.
Oh, got it. Okay.
This is from 2000. This is from 1987 to 2005. So it includes a couple of recessions. It just doesn't include the Great Recession.
Right.
But I like this because it's a good amount of years, right?
Right.
But really, I think the most important thing is for a value investor, you're looking at maybe 1 to 3 year investment, and that's the problem. Because you're aiming for the change of multiple. The change of multiple, I think, is one of the most important areas.
Of course.
For a growth investor, the holding period has to be greater than 10 years. Someone is a growth investor and they're trading they're trading a portfolio, rotating the entire portfolio multiple times a year. They're not a growth investor.
Or they're not really having a good shot to capture what should be the drivers of growth.
Exactly.
Because that should be, what's the 60% is growth? It's just sales growth.
It just becomes a bigger proportion of the total shareholder return
as you hold longer.
Yeah.
Interesting. Okay. And this was a good period for value too. This is a period we're stepping out of this weird 2015 to 2021 period where value was the worst thing you could have owned. The more I've learned about how this works and sources of return and why investing in productive companies should have a return to it above the quote unquote risk-free rate, which we know is very, very small today. In my indoctrination into the value world, which no one did, I wasn't recruited by any cult leader. It just happened naturally, as it does to many people. I
mean, I was a value investor until probably 2018.
Interesting.
Okay. I was purely a dividend kind of portfolio kind of guy. Hey, let's create a portfolio that generates enough dividends.
Yeah.
But then, I saw the light of the tunnel. I don't know.
The growth light.
Yeah.
The lighthouse, the growth lighthouse. You were on a stormy sea of dividends and the growth lighthouse showed out.
And then I shifted. I would say I shifted in a good moment because then they just say,
you did shift a good moment. That's excellent.
Those stocks went up faster than SpaceX went to.
SpaceX went to wherever it went. Yeah.
Yeah.
So I still hold this feeling that, let's just say you're going to own 50 stocks, right? And that's what you like to own. I still hold this feeling that if you were to focus that on a set of growth portfolios and really stretch yourself on valuation, what you're functionally doing is setting yourself up for a wider range of total shareholder return outcomes. When expectations are high, it's like, to me, it's like landing an airplane on a shorter runway. Like, you just have to get more things right, and there's more that can go wrong when embedded expectations are much, much higher compared to when embedded expectations are lower. What do you think about that?
I totally agree. So that's my biggest fear, right? Because now everybody has expectations that the growth will be like this forever. The best fears for growth is when they say, "Oh, this company grew enormous amount of money. Now they can't grow much faster, so we are gonna project in the future that the growth tapers out." Mm-hmm. And then what ends up happening is like what Google happened. No, growth just remained stable for the next 10 years. So all that differential that got generated was an incredible lift up.
Was under priced expectations.
Exactly. And I think that is the main reason why growth outperforms, is because many of the people, rightly so, everybody believes that, the growth story, like it goes like this and then like this. But in many cases, the ones that really make it to, big companies, they hit like this, but then they stabilize at a much higher point than
higher plateau.
Yeah. And that's what happened to Google, and that's what happened to Amazon, and it seems that that's what's happening to Shopify. Like, a lot of the growth stories are because of this.
What about? I agree that totally makes sense. That there was a period of extremely high growth. The investors on the whole said, "All right, we're now growing on this bigger base. Compounding is a lot harder when you're starting at whatever 100 billion and getting much, much bigger than that." And then these companies happen to outperform. But that underlies how extraordinary this period is, and in particular, those companies at the very top of the S&P 500 and the NASDAQ have done. They've done something almost unprecedented, which is become behemoths. Right? They were behemoths in 2016, 2017, and then continue to compound and grow at pretty insane rates and eat more and more of the world. If you said, okay, I understand that it's harder maybe to invest in companies, it's more difficult to make good selections on companies that have fast growth and have higher embedded expectations. What can I do to maybe mitigate that? Like, how do you look in the value bucket or the value section of the growth bucket, right? I want to look at companies that are growing that I think are the future, but I don't want to pay, multiples that people make fun of on podcasts. How do they do that?
I think a big problem is that a lot of people use screeners to screen for stocks, even like automated ways of integrating into an index. You integrate index into an index because they're fast growers, or they have, growth stocks because they're growing. But what happens when you have a typical company that has two products, A and B, where A is, the 80% of the sales, but growing at 4%, and then B is 20% of the sales and growing at 60%.
B is more important in not a very long period of time.
Yeah, but what ends up happening here is that from a screening perspective, when you're just looking at revenues, it shows like this company is really bad, right? It's
not growing fast.
Yeah, and it will be priced accordingly. It will be priced at a much lower multiple. But internally that there are internal transformations here that are happening, that eventually that growth rate, just because of the nature of those two products, one is growing faster than the other, then the average growth will actually increase over time. And so if the expectations are aligned here, if people aren't figuring this out, that there's alpha there. Right, where you can actually see the future where the growth rate increases, and as a result, the multiple should increase as well. And so you have a double whammy here in terms of, you will have faster overall growth over a longer period of time, and you will have a higher multiple attached to that company because of the higher growth nature. And
Interesting.
So these are called companies in transition. I think there's a standard case study that everybody should learn about, which is Adobe. They went from perpetual licenses to I forget what they're offering. Yeah, subscription, but I forget what they're offering, like their creative suite online. And when they moved from perpetual to to cloud offering, they lowered the price, and as a result, the revenue came down. But the growth, they just adopted way more people into the platform because a lot of people weren't paying for the license anyway. So they brought a lot of people from the gray market into the legal market, I would say, and their growth. And then they did this transition in 2012, April 2012. They started this transition. They have 18x since then.
The stock price, 18x?
Yeah, total shareholder return.
Wow.
Then a couple of years after, or just like a couple of years ago, Autodesk started that. You know, Autodesk, it's kind of like the computer-assisted diagramming, or I forget what it's called, CAD software.
CAD stuff,
for engineering and construction, and they do for other stuff too. And they started moving from perpetual to subscription, and they can offer different things, more things, right, with perpetual license, subscription licenses. And then there's some other companies that are, approaching that, that transition as well. And it takes time. It's costly in terms of revenue growth for a short period of time. It's costly on the margin. Like the margins usually contract during that period of time. And so unless you have an investor base in that stock that understands that story, you're not going to get a high multiple for that period of time. And so I think that is the way you trade this. Because it's very expensive to buy into. I'm not saying Google, because Google is like a behemoth, and I think the market still really thinks that the growth will eventually peter out, and so it doesn't have that multiple. But you have other smaller companies like Shopify and Cloudflare that have extraordinary multiples. It's just because the total addressable market is gigantic, and they just have that path towards growth that everybody sees.
How would you tell a layperson to, like, what are a couple metrics that you would check? So growth rate is tough because it's very dependent. It's very super time period dependent. Like I could go back and find a time period when the growth rate looked excellent or looked crappy, and it's really hard to assign that. And if you study the academic finance ways of like Gordon growth model, right? The number you assign to G, whatever you assign as the growth, is like by far the most sensitive variable. Like it makes or breaks any given model.
Yeah.
How do you think about that in growth companies?
Yeah, that's the toughest question. What is it? The next 10 years growth rate going to be? Actually, it's more important. It's like, what is year 5 to 10 look like? Mm-hmm. Nobody knows. Right. And so you just have to be, at that point, I think what becomes very important is like leadership, culture, the founder there. It's just a person who's going to work through those issues, mm-hmm. and not someone who's there for the last 5 years of their career and just to cut the check and get the I think it's a totally different mindset when you have someone who's like 37, has like 20 more years to it, and he's going to push through all the difficult choices and issues. That's why I really believe in like founder CEOs, like Pinterest itself. They're going to work through their issues. It's going to take time. I just don't want to be in there for the next 4 quarters. So, because the honest truth is, like, if they don't see progress in the next 2 quarters, like, they're going to continue to get hammered. It's just like that transition from a growth, non-growth is very painful.
I wasn't following that closely, but I thought that was the narrative with Snapchat, right? Like if Snapchat IPO'd at what, like $12, $15, maybe $20.
Yeah, nobody was giving them the time of the day.
Yeah. And they were the broken growth story. They've since, I don't know, 10x'd from their bottom.
Yeah, the problem is like, they surfed kind of the 2 waves that are really important. One is like they're very strong in like the home improvement area.
Pinterest.
Yeah, for some reason, like it's the people that use them are like middle-aged women who are focused, who own their homes, very strong like homes improvement, kitchen improvement, decorations and stuff like that.
Domestic stuff.
Yeah, COVID just expanded that, right? Because you're now at home with your middle-aged wife, and she's using it nonstop. You're finding in like a new interest in like, doing stuff around the house, you ask for ideas. She sends you like a Pinterest account. She opens her Pinterest account and it has like thousands of pictures of what we should do.
Right.
So I think that's the reason it really expanded very quickly. And now that's we're for a short period of time we were opening up, and people were returning to work and stuff, and so that's going to take a hit. Also, they're switching over. Their mobile is where the growth is. Mobile Pinterest.
Mm-hmm.
There's an issue there. It's very hard to that's the whole system that Pinterest is underlying infrastructure of Pinterest, like the way you interact with the website, isn't very translatable to the mobile. So they have to figure out a way of creating something that has high, engagement. And they have examples like TikTok.
You think it's a better desktop product by far?
Yeah, well, it originated as a desktop product. They just haven't figured out mobile yet.
All right.
So there we go. That's the issue. And it took Facebook 4 quarters to figure out mobile. I remember everything changed when they introduced the feed. Yeah, growth stories, when they break, it's risky. You got to get out quickly. Don't hesitate. Don't think they're going to come back. No. You're in it for the growth. You're mentally, you should be mentally write down, I am in it for this 5 reasons into this stock. The moment the growth story breaks, you got to get out.
Fair enough.
Yeah.
Any final parting words on this growth thing? Wisdom for people who want to be growth investors.
I think growth investors is a very optimistic
bunch.
Yeah, I mean, we're all looking at what's the next opportunity. What is the next 10x bagger? That's what they call it, right?
10 bagger, yeah.
They want what is the next 100 bagger? I want 100 bagger in 10 years. That's literally impossible. I think 2 companies have done that in the history of stocks.
Yeah.
But no, there have been more companies, but
sure.
It's incredibly difficult. But it is I think in the last 10 years, it's outperformed value.
Oh, big time. When it starts to click for you that there are embedded expectations in every company's price and that it's worth dissecting those if you want to get into how they must perform in order to meet those expectations, that's I don't know what to call it, but that's a leveling up for a lot of investors and what I try to encourage people to do and think about. But to me, I'm still on the Seth Klarman margin of safety. Cheap things re-rating. I think I said this in last week's episode, but that sense that value, that chart actually jives with the chart you showed earlier, jives with the fact that value re-rating, you just don't know when that's going to happen, right? So value's returns are going to be chunky. They simply will. They're not going to be smooth. And I think it's well argued that it's at least very, very difficult to time when those re-ratings would come. The cool part about this is you can capture both of these phenomena in very easy ways by owning things like the index, right? Which it'll fluctuate in terms of how much you're allocated to things that are value and things that are growthy, but kind of remarkable that all this fun stuff gets captured in there, and you could just not be paying attention at all. Pretty cool.